In Chapter 5, we are going to use cost, volume, profit analysis, abbreviated as CVP and frequently called that. In essence, in CVP analysis, it is very important to start out with the contribution margin income statement format that you see on the screen. So an income statement format and contribution margin basically takes sales minus all of your variable costs. Remember that variable costs can be both cost of goods sold as well as variable admin and selling expenses. All variable costs are subtracted from sales in order to come up with the contribution margin. In the particular example you see on the screen right now, you see $10 is a per unit price. $7 is what our variable cost for each unit is. You recall in the previous chapter we did some high-low analysis where we looked and calculated the incremental variable cost for each additional unit. That was actually considered the slope of a line. When you do the y equals mx plus b equation of a line format, the m is your slope. M represents variable cost. The contribution margin by definition is the difference between them. In essence, what this means is that you will make $3 on every unit that you sell. That $3 then needs to cover your operating expenses, your fixed expenses, in order for the company to make a profit. I put together this just a very simple analysis so that we can do some mathematical computations and look how this comes out. So the assumption here is that we're going to sell 1,200 units at $10 a piece. Those 1,200 units, it will cost us $7 variable cost to make those units, which would also include the cost of acquisition, any direct materials, direct labor associated with it, and the variable portion of your manufacturing overhead. So again, I will need to multiply that $7 times 1,200 units. And in essence, you can see that what I want to do is subtract my variable costs. If you look at this, knowing that the contribution margin is $3 for every unit, I should be able to quickly calculate 3 times 1,200 units, that the difference between sales minus my variable cost will be the contribution margin per unit times the number of units. So it is actually a shortcut to calculating profit. If the company has 2,000 fixed expenses, we will make $1,600 of profit at the volume of $1,200. Okay, so again, the formula income statement format, contribution margin. Sales minus my variable costs gives me my total contribution dollars at this level of activity, 1,200 units. At the level of 1,200 units, we have a fixed expenses of $2,000. When I subtract that 2,000, you can see that we come ahead by 1,600. Why do we need to know this? That information is very relevant in making decisions for management. I'm going to quickly calculate a contribution margin percent. So I will take that $3,600 in total and I will divide it by my sales. I have 30% contribution margin. I could have done the exact same thing if I had taken it on a per unit level, $3 times, divided by, $10 gives me 30% as well. Okay, so it doesn't matter whether you do it on total dollars or whether you're going to do this calculation on a per unit basis. What's important is that you use all variable cost, and I'm going to put in parentheses here, the variable cost of goods sold and selling and admin. You need to include all of those costs in order to calculate contribution margin. All right, what's our purpose? Our purpose in CVP analysis, which is cost, volume, and profit, is first of all to understand where our break-even point is. Okay, break-even, the definition, means that I have sales and profit that generates all of my, covers all of my cost. So at break-even point, my profit should be 0. So I am working on this income statement in a parallel, backwards fashion. At the break-even point, profit is 0. Now, if you recall, we had done the chart for the cost analysis in Chapter 2, where we looked at a fixed cost. A fixed cost represents a parallel line, horizontal line, parallel to your x-axis. In other words, it wouldn't matter how many units we manufactured, whether we have 0 units, 100 units, 200 units, 300 units. Within a relevant range of activity, the cost stays the same. Example, insurance on the factory or insurance on the building. Salary for an individual. Doesn't matter how many units they make, they get paid the same. Okay. So that's just an example. So the dollar amount stays the same. However, you know that the per unit is going to decrease on a per unit level as I move towards more units. Again, let me just do this as an example. If I put $1,000 of cost there, when I have 100 units, it's $10 a piece. When there's 200 units, the cost drops to $5 a piece. 5 times 200 is 1,000. When there's 300 units, oops, my math is going to be bad. 3.33? 3.33 times 300 will get me 1,000. So as I increase the number of units, the per unit cost decreases. Again, that was one of the objectives that you would learn earlier. All right, taking you back to this break-even analysis. So it didn't matter how many units I made, the fixed cost stays the same. And that's a concept you're going to have to remember, especially as you're working your way backwards into calculating the sales to break even. Okay? So if you notice in the original example here, okay, we took sales minus my variable cost to come up with $3,600 that covered all of our fixed expenses, but actually provided us with a little bit more than we needed, and therefore we generated a profit. So in other words, if you look at this analysis working backwards, I need to generate $2,000 of contribution margin in order to cover my fixed expenses in order to break even. How am I going to figure out what my sales are going to be? Well, we calculated we make $3 on every unit that we sell. So if I think about that, I'll take my $2,000 and I'm going to divide it by $3. When I divide that by $3, and I'm going to do it in the field next to it, okay, it tells me that I need to sell 666.67 units. In essence, I can't really sell a part of a unit, but if I sold 667 units, I should make just enough to cover all of my fixed expenses and generate a tiny little bit of profit because of rounding. All right? So let's see if that really does happen. Okay, so if I take 667 units and I multiply by our selling price of $10 a piece, and then if I take those same 667 units and I multiply it by the variable cost to make each of those units of $7 a piece, oops, okay, let me see, my rounding is just a little bit off on position here. Let me make both of these dollar values, and then we could see how they round up. So in essence, what you see is that I make $1 of profit. Or, okay, so minus, oh shoot, I wasn't expected to do that. I'm going to subtract the 2. Okay, and so you see, because of the rounding, I'm going to come up with $1 of profit because I can't make a part of a unit. Had I made 666.6667 units, it would have come out perfect. Okay, so in essence, I can use this contribution margin income statement to work my way backwards to figure out what my break-even point is. All right, let me just do one other scenario before I move off topic and go on to another subject. Right, well, let's just start over here, okay? And let's say, well, the company wants to make, let's say we want to make $5,000 of profit So this is a target profit objective. So in essence, in order to make $5,000 of profit, I have to cover all of my fixed expenses, and I have to generate a contribution margin, working backwards, of 7,000. All right. So 7,000 minus 2 would generate the desired profit. Okay. So again, well, how many units will I have to sell? Or what should my contribution margin be, or my sales dollars be? There are actually two formulas, and you'll see them in your book. Okay, you take your contribution margin and fixed cost, and you divide it by your contribution margin per unit, and that will give you the number of units needed to meet your objective, whether it be break even or whether it be a target profit objective, right? But the answer is going to be in units, just like we did the example with 667. So let's go with this particular example. The fixed cost, okay, was 2,000. But in this case, I don't want fixed cost to hit break even. I want a target profit. So I'm going to add that desired profit as though it was a cost. Okay, and I'm going to divide that by my contribution margin per unit. Right. So in our example, we want 2,000 plus 5,000 desired profit. We're going to divide it by our $3 per unit contribution margin given here. Okay, and thus I'm going to have 7,000 divided by $3 per unit tells me I need 2,333 units. Okay, now we're going to go do the math on that, and I'm going to do, okay, we sell them for $10 a piece, so 2,333.33 units times $10. Okay, remember that the cost is going to be 2,333.33 units times $7, the variable cost to produce. So when I subtract these two, 23 minus 16 is 7,000. I would cover my 2,000 of fixed costs, and I have that desired profit. Right? So I could just work on it working backwards. 7,000 divided by $3 per unit told me how many units, 2,333, right? And then I'd have to multiply by the sales dollar amount, $10 a piece, to find out what my sales needed to be. All right, another way to do that is actually to take that fixed cost plus your target profit, and not to divide it by contribution margin per unit, okay, but to divide it by contribution margin ratio. If I do the ratio, the answer will give me, in this case, target profit, okay, in sales dollars, because I used a ratio, not a per unit. When I use per unit, it gives me an answer in units. All right, so let's just kind of work through that same scenario again. Over here we had $7,000 was what we needed to cover from the standpoint of our fixed cost plus our desired profit. And this time, instead of dividing by $3 per unit, we'll divide by 0.30 or 30%. Okay, the contribution margin rate. Okay, so when we do that multiplication, $7,000 divided by 0.3 gives us $23,333. I made the field too small. Okay, and that's my sales dollars required to generate $5,000 in profit.